Joining us now is DoubleLine Deputy CIO Jeffrey Sherman. Are you guys bullish on bonds over there, Jeff?
Yeah, there's reason to be, just given some of the weakness in the data as of late. But it also depends on what we're talking about too. So from a rate perspective, rates could have a little bit of a rally from here. Although the front of the curve really did move pretty sharply over the last, let's say, 2 weeks of trading. And maybe it's a bit overbought at this point. But what we're seeing here is some of the weakness in the credit spreads across corporate bonds specifically. And it's bleeding over into other areas of the credit markets as well. But what you're seeing is that this fervor and this passion for everything risky has really started to wane over the last couple of weeks. And I think it's really just this talk about the tariffs, and that maybe it's not just bluster, maybe it's just not negotiation, maybe it's not just a transactional behavior, but maybe it's actually reality. And so you're starting to see some of that. And I heard you guys discussing the ISM services. We always hang our hat on services for the economy because it's such a large piece of the overall economy. But when you dig underneath there, once again, it's this prices paid component that continues to be up. And so I think a lot of the fear you're seeing in the market right now, one is high valuation. And when there's high valuation, there's not a lot of room for error. And given some of the tariff talk as of late, and just how aggressive it looks and appears to be, and across the board it appears to be, that it really is starting to impact risk assets. And so I think what really one needs to focus on right now is just finding quality still in the marketplace, right? Things are analyzable, things that can go through the headlines and get you through the next few months.
What about the stagflation narrative that has developed? I mentioned it when we saw the ISM manufacturing number earlier this week because prices were higher in that, but activity was weaker. Is that bond bullish? Do you buy that story is starting to creep in?
Well, that one's a tough one because, we throw on this word stagflation, and I joke about, is it really stagflation if we just have slow growth, but we have some 3 or 3.5% inflation rate? I mean, stagflation is what we saw in the late 70s and early 80s, right? And so I think what the concern here is that the inflation is not really subsiding, at least in a manner to get the Fed to want to continue back on the path of rate cuts. And so I think the challenge you see, it's in manufacturing. Obviously, when we start to talk about imposing tariffs on steel, aluminum, various cars, all the various input costs on the manufacturing side. But then you're also seeing on the services side as well. And don't forget that we still have a tight labor market. And so I think this idea that you're not going to get volatility through inflation is just a bad one still. It has not went away. This is why the Fed has told you that they're going to be patient in terms of cutting rates, and you just continue to see it through various data sets. So the good news is there is some economic activity in the services data today that dwarfs the manufacturing activity about 4.5 to 1 in our economy. And so we'll hang our hats on that today on why you're kind of seeing this reprieve there. And also, again, Lutnick's headlines of coming about and saying, well, maybe we won't impose the tariffs, maybe we will. Let's just choose one way or the other. And I think that's what the market's looking for right now. It's breathing a sigh of relief on the economic data right now. But we've got a big calendar coming up. As you mentioned, we got unemployment claims tomorrow. We'll see kind of if there's more of that government layoffs that are inside of there. We'll also get the jobs report for February, and we'll see how strong that employment component of the ISM services data that we saw today leads through into how much job creation there was.
Yeah, we mentioned ADP earlier this morning. We got Trudeau, a story on the tape saying that Canada's not open to removing retaliatory tariffs unless all of ours come off. But I got to get you, Jeffrey, on German yields and whether or not this 10-year move over there makes any sense, and how much more could be done if they do some work on that debt brake.
Yeah, I mean, look, this is spending, and for all of the kind of rhetoric and some of the criticisms about the defense spending and the headlines we've seen in the last couple of weeks, definitely Northern Europe has woken up to the defense spending argument. And so you're seeing that, and the relief valve there are yields. And, $500 billion of spending from the German government coming towards defense. The fact that they're removing some of these caps, potentially some of these kind of ECB-backed bonds out there, where they're going to issue more for defense spending. And so there's a reason for we're seeing some of that convergence in yields. And I think that's going to continue over the near term. And so I wouldn't want to step in front of that today as a buyer. It probably does continue to lend to a little bit more weakness in the dollar, specifically through the euro. We probably get back to about 110 on the euro, just given some of these moves we've seen as of late. But in general, that's kind of a one-way train right now, where we're talking about potentially being more austere. We'll see how that goes through Congress. But definitely, I think there is going to be more of a convergence between, let's say, German bunds and U.S. 10-year Treasuries.
It's not really going through Congress at this point. Jeffrey, thank you very much with Eurodollar 107.
What's Congress?
From DoubleLine.